but it really sums it down into 5 key things. Objective, right? What's your objective? Why are you investing? Because if you're looking specifically at like cash in the next year, you're going to invest very differently than if you're investing for 20 years from now. Time horizon kind of goes back to it. It's like, you need the money in 6 months. Don't go investing in penny stocks. Don't go invest, you know what I mean? You're going to invest completely different if you need the money in 5 years versus if you need the money in a generation away from now. Not you, your kids, you know? You're thinking about your kids, not you. You're going to invest very differently. 3, what's your risk tolerance? Could you handle that drop in the market that we just had from February 19th to March 23rd, where you saw 40 to 45% drops on not just the broader index, but sometimes even 60 to 80% on some of these individual securities that we're seeing? Think Boeing, think Carnival Cruise. Can you stomach that? And if you can't, then think about what a better investment class could be. And that volatility, we're seeing 5 to 10% swings, you know what I mean? Like that should be included in your risk tolerance, you know what I mean? If you can't handle 5 to 10% swings that we're seeing in some of these securities on a day-to-day basis and like shrug it off and laugh and kind of be emotionless about it, then, you know, think about your investing strategy a lot harder than you are now. We touched on this one earlier. How active or passive do you want to be? Do you have the time commitment that you can attribute to investing in individual securities? If you don't, and you kind of just want to like put the money away and let it do its thing, index funds, man. You know what I mean? Warren Buffett says it all the time. And then the last one, I think that's the last one. How often are you going to be contributing, right? If you're going to be contributing once, and unfortunately, let's say somebody gave you a gift of like $1,000 and you're like, I work paycheck to paycheck and I'm probably going to be working paycheck to paycheck for the next 20 years. And unfortunately, that's just the way my life is. I need this $1,000 to get to $1 million in 20 years for me to even think of having some sort of retirement. You're going to invest way differently than if you're going to be getting $1,000 a month, or luckily you have a job like me where you're able to put away 50% of your income. You know what I mean? You're going to have to get way riskier in your potential investments. If I just need to get to 2.5 million, which is around where I'm thinking I need to get to like get to the point where I'm like really happy, right, with the income that's coming from my dividends, way past FIRE or early retirement and stuff like that. Like this is a little bit beyond that, but it's going to take me, you know, way less time. I mean, I'm already a fifth of the way there, you know, 15 to 20% of the way there. And that's not even talking about just like happily retired. That's like you got extra luxury sort of money, like G-Wagon money at that point if you really want it. Yeah, you're going to invest completely different. If you just have that 1,000, you need to grow to $1 million. If you're getting 1,000 a month and you need to grow that to 2.5 million over 20 years. So that's really where I condense all of it in. And I can shorten it to like 10 words: objective, time horizon, risk tolerance, frequency of contributions, and active or passive.